and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into topics and trends that we will be exploring today. My name is Charles Mesquita. I'm Charities Director at Quilter Cheviot, and I'm very pleased to be joined by Richard Carter, our Head of Fixed Interest on the research side. Remember, so that you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening to. And you can also follow us on hashtag QC Weekly Comment. Richard, as per usual, the US is dominating the news. And certainly we're being asked a lot by clients of whether markets are defying gravity, despite the big, beautiful bill, Trump's wonderful tariffs, and the longest ever US government shutdown. So why have markets been so strong, and do you think that can continue?
Charles, yeah, that's a great question. I think it can continue. I mean, clearly the big thing this year has been sort of the whole AI investment boom and the performance of tech companies, which really are continuing to do very well. So as long as that's the case, there's no reason why markets can't move higher. I mean, I think also there's a sort of kind of bigger thing going on here. You know, we started the year and we went, and then as we got into the Liberation Day tariffs, you know, there was a big wobble then, and everyone thought this was going to be a disaster for the global economy. We were going to see inflation go up, and it was really going to be very, a bad move by Trump. But actually, it's almost a dog that hasn't barked. You've not really seen much inflation come through from it. Growth has held up reasonably well. And then the rest of the world, places like Europe, are also investing in things like, defense. So actually, there's been quite a lot of good news to offset what were the worries about Trump's tariffs policies. The other thing that's happened this year as well, we shouldn't forget, is that interest rates have been coming down. It hasn't been, very fast. It's been a very gradual process, but markets are pretty happy that we're seeing lower interest rates. So as long as I think that's the case, as long as inflation doesn't spike up, and as long as tech continues to do well, there's no reason why markets can't move higher by year end.
And we're still expecting the Fed to cut again this year, but the Bank of England probably not.
Well, you mentioned the US government shutdown. There's been a complete sort of lack of economic data for the last few weeks. So there really is a big fog over markets. That's now going to clear. And we'll see what the latest job numbers are in the US, because really they are what matters for the Fed. I think at the moment, actually, some Fed officials are a bit reluctant to cut again in December because they still think inflation is quite sticky. Whereas in the UK, on the flip side, the latest numbers on inflation and wages have basically a signal that the Bank of England potentially could cut again by year end. So, yeah, I mean, I still think it's still going to be a gradual approach from both central banks, but direction is still lower for now.
And we've also seen Trump actually reverse a few tariffs, haven't he, to try and bring down the cost of living. So inflation obviously is still stickier than we might imagine.
Yeah. Of course, he would say that China pays the tariffs and they don't push inflation up or anything like that. But obviously, when it comes to beef, coffee, and bananas, it's a different story. It's proved to be pretty unpopular, and he's had a few attacks from Republicans on that. So decided that it'd be a good thing to start cutting those tariffs. But a bit of a U-turn from Trump.
And the other thing that's sort of causing investors concern, isn't it, around the size of government debt, both here in the UK, well, in most of the developed economies, and in the US. Should this be a concern? And I suppose the second part of that question is how do we start getting that debt down, or is there no intention of doing that?
Well, the US doesn't seem to have any intention of getting it down. I mean, these worries about government debt, they come and go. They're a sort of theme for a few days or weeks, and then suddenly no one talks about them again. I mean, you've had issues with France this year and the politics there, the big, beautiful bill in the US as well. You've had issues in Japan and obviously closer to home in the UK as well. It is a concern, but it's not really reached a point, particularly in the US, where it causes stock markets to fall significantly. We may reach that one day, but for now, the US seems to be able to keep borrowing, and as long as the economy is doing okay, no one seems too worried. How we'll get the debt down, is a very difficult question. I mean, inflation, inflating it away is one way, but the UK tries to stick to the fiscal rules and get the deficit under control, but other countries show no signs of doing that, and I'm afraid the debt to GDP ratios just keep going up.
Yeah, and it wasn't that long ago, certainly in the UK, we can remember when inflation was very high, bringing down Second World War debt, but actually very painful for those living through it.
Absolutely.
So, yeah, I don't think we want to return back to that. And the other thing I think is creating concern, although it's it's a reasonably long way away, is the concern over the independence of the Fed chair. And Trump continues, obviously, with his comments about Mr. Too Late Powell and trying to put him on pressure of reducing interest rates. I mean, how significant is the independence of the Fed, and how likely do you think we'll get somebody who is going to be independent?
It's a massive issue. I mean, certainly for the bond side of the market, but then that, jitters in the bond market have a habit of translating over into the stock market. So it's huge. If you got to the situation, for example, where the market felt that even though there was inflation problems, the Fed was going to cut rates because Donald Trump was telling them to do so, that would cause a big drop in the dollar, a big rise in treasury yields, and I would think a sort of associated fall in stock markets. It's really something, the sort of independence of the Fed and the predictability or good sense of interest rate policy is really, I think, partly a bedrock for the whole financial system. So it is a worry. If he appoints someone, I mean, he's already appointed someone to the Stephen Mirren to the committee. He's voting for quite significant rate cuts at a time where a lot of the others on the committee are a little bit more sanguine. So we'll see who he appoints and how independent they are. But yeah, keeping inflation low and keeping growth on the right track is so important. So it would be a concern if Trump does something daft.
But I mean, Powell is only one, isn't he, of on the board? So actually, the independence is going to be wider than just the Fed chair.
Yes, he's only one, and you've got a committee, but the chair is very influential. And if you were in a situation where, let's say, 2 or 3, including the chair, were voting for aggressive rate cuts at a time when inflation was a problem, and everyone else who was independent or supposedly independent was voting against them, that's not a happy situation for investors, as far as I'm concerned.
And the other thing that might keep him honest is you're going to be having midterm elections around then as well at the same time.
Yeah, you are. But we also saw that with the whole Liberation Day thing, it was really the jitters in the US Treasury market that caused him to water down some of the tariffs. And I do think they are very sensitive to what happens in Treasuries. So hopefully they won't, overstep the mark.
So despite the rhetoric, the markets still remain a pretty robust break on the administration.
Yeah, I think so.
Yeah. Thanks. One of the other issues a client of mine raised the other day was around an article in The Economist, which was, I think, in last week's, where they talk about the ownership of the US market with over 60s, which is estimated to be around 39%, twice as much as it was between 1989 and 2009. Is this something you've picked up on your radar? Is this something that investors should be concerned about?
I mean, I'm not sure. I mean, I read the article. I'm not sure I would be massively concerned about it. I mean, it seems to me that a lot of it is due to people living longer and, the older population in the US having lots of money to invest. So you can't really blame them for wanting to put that into stock markets. I mean, I think maybe a few years ago, more of that money might have gone into bonds, but the performance from bonds has been nowhere close to what it has been from US stock markets. And to be honest, inflows into funds and whatnot tends to follow whatever's happened with performance. So I can't say it's a massive surprise. I guess the risk is if you saw big jitters in the stock market, maybe sort of 10% drops, and then people, and aging, older people didn't have the ability to tolerate that risk, that could add to the selling and add to downward pressure on the market. But as long as things are going okay, I don't see it as a huge concern.
Yeah, and we've seen a massive. So back in the mid 80s, the average man was expected to live, I think, for 12 years on retirement, which was slightly earlier than it's now. And now it's down to whatever it is, 23 or 28. So there's been quite a significant extended potential retirement, hasn't there?
Yeah, no, exactly.
And that will do it. And the other thing that I think is also increasingly concerning investors is around the amount that the US market makes up of the MSCI world. I have to say, I had forgotten that it had increased from about 30% in 87 today, when it's about 72%. And that really is a huge change, isn't it, of what's gone on? I just wonder what the catalyst for that change might be. I'm just sort of thinking, India and China and the size of their economies, and when that might start having a greater impact on world markets.
Yeah, you would think with the growth of India and China, although the economy and the sort of investable stock market is not necessarily the same thing, is it? And attractive economies, you would think that would somewhat reverse. Also, maybe Europe becoming a little bit more attractive as well. But I think really it's partly just sort of US is an attractive place to invest because the economy does well and there's sort of predictable interest rate policy for now. But also, of course, just the sectors, the predominance of tech, or a lot of the best, or most investable tech companies in the world are American, and they just seem to reinvent themselves all the time, don't they? So I guess if there was a wobble in the tech sector, that would be where you would probably start to see the US share of the MSCI start to come down. But it's up to other countries to try and catch up a bit, I think.
Yeah, and they have been remarkably resilient to absorb change and adapt, haven't they? And also the other thing I was sort of reflecting on is about the tech sector is, back in 2000 when we got the dot-com bubble, at that point, these companies weren't making any money. If anything, they were making massive losses. And today they're actually generating quite significant returns. Just slightly closer at home, Richard, we've got the Rachel Reeves budget on Wednesday, the 26th of November. There have certainly been plenty of kites being flown. I'm not sure that I'm particularly clear about what is likely to happen. If I ask you to get your crystal ball out, what do you think we'll be seeing in the budget?
I'm not sure it's kites. It's more like a sort of roundabout and what announcements being made and then leaks saying it's not going to happen. I mean, the latest one is sort of income tax is supposed to be going up, and now apparently not. And supposedly that's down to sort of better economic forecasts from the OBR, but I'm afraid with all the doubts over Starmer's leadership, it's hard not to see it as another sort of U-turn led by weakness from the Labour government. So it's a worry. I mean, I think the big thing is, for markets, they're going to stick to the whole fiscal discipline message, try and increase the headroom that they've got and overcome some of the gaps in the public finances. But as to what the policy mix will be, it's going to be hard to say. I think probably something around income tax thresholds being frozen will probably be one of the big ticket items, something on gambling sector, things like that. But even with a sort of week or so to go, there's so much scope for it to change. You just hope they make the numbers add up.
Yeah, the problem is with the increase in the living or minimum wage and national insurance contributions last time had such a negative impact, didn't it? I have to say, traveling on trains this week, various conversations I've had with the general public, they're definitely concerned about what the impact of this is. But I would have thought that if she wants to keep that fiscal responsibility, she's going to have to break a manifesto pledge or two on that basis. Anyway, Richard, thank you for that. We definitely live in interesting times. Hope you enjoyed the podcast today. Please do like, subscribe, and if you'd like for us to cover any particular topics, send us an email via our website. You can also stay up to date with our thoughts on markets, industry insight, and our upcoming events and webinars on our website or our social media pages. Look forward to you joining us next week.